In three, two, one. Welcome to the Von Nelson Podcast. Today is the third installment of Winners and Warnings, and with me today is Deputy CIO Adam Rich. Welcome, Adam.
Good to be here, Dan. Thanks for having me.
All right, good to have you back. And today we're going to talk about what a new paper that we just put out. It's titled "The Illusion of Abundance." It's the subtitle here is "The world did not run out of oil; it ran out of reinvestment." And before we just step right into that, Adam, let's refresh everybody with the capital allocation framework. Run me through again, what that is, and how does that team use it to find opportunities?
Yeah, the capital allocation framework is our process to help us find companies with improving return on invested capital. We believe the market fundamentally misprices these companies for a lot of different reasons. The first being that in order to improve your return on invested capital, most companies have to make investments to increase their scale. And the markets misprice those securities because they penalize the investments early on. Second, because of passive flows, markets are gravitating more and more towards companies who already have high return on invested capital, and it punishes the companies who are not having those same levels of ROIC. And so the capital allocation framework is a process we have to help us identify companies who are accelerating investment in a very focused way that we believe will drive higher return on invested capital. And we also do that same analysis on industries and countries, and that helps us really find stocks that have high probabilities of improving ROICs.
All right, so the paper is called "The Illusion of Abundance." Where'd you get that from? What does that mean?
Yeah, right now we're at a very interesting moment in the oil market. For the past 15 years, the industry has been trained on shale oil. Shale has a lot of unique attributes that are not really repeatable around the world. The first is that most of the infrastructure was already built out. All the laws and infrastructure from the 1970s were here, and you were able to drill a well and get production within a pretty short time frame, usually in months, 3 to 6 months. And the industry has been really trained on that quick response time. So if the price of oil is high, they can accelerate investment and get production pretty quickly. And when the prices are low, they can cut back and rebalance the market pretty quickly. And so for the past 15 years, the oil market has been really trained to have this type of supply readily available. However, right now, I think that's very, very different as the marginal barrel is not going to come from shale over the next 3 to 5 years.
In the paper, we're talking about potentially $60 oil. How can oil be at $60 if what you're saying is the scarcity is coming?
I know that's what's so interesting about this moment in time, because OPEC right now has actually ramped up their spare capacity. And so they have added a lot of barrels over the past 12 months at a time where shale oil is seeing its lowest reinvestment level. And so while the price of oil is definitely telling a different story about the market, what's happening is we have exhausted all of our excess capacity going into what could be a really good 2026.
All right, and so thinking about again through that capital allocation framework, what does that data show for you? What are your team? What are you picking up?
Yeah, the capital allocation team has been great here. Isabella has done a lot of work on this. And what's interesting from the data that we have seen over the past few years from the largest oil and gas companies, and not just the US, but everywhere, is that they have generated about $1 trillion of excess cash flow because of the war, right? The price of oil went up, and so there is a lot of excess cash flow from these oil and gas players. What's interesting, though, is that 60% of that went to dividends, 25% went to buybacks, and the rest went to chemicals and renewables. Almost none of it went to oil and gas reinvestment. And so that's where we're sitting at globally. While shale has attracted some investment, it's been offset by lack of investment everywhere else.
And so you're talking about some of these narratives that exist out there in the marketplace. How do those end up falling the capital?
Yeah, I mean that's what we love about the capital allocation framework is that typically we can see what the narrative is going to become before, because the way capital is allocated today sets up the situations that the world is in a few years. So right now, everyone is really scared because of lack of demand. Maybe it's peak demand. But what's the capital allocation story is saying is there's been no reinvestment now for almost 5 years. And if US shale cannot grow, what's going to happen to supply over the next 3 to 5 years?
All right, Adam, and then let's put this into historical times. Looking back in 1970s, 1980s, tell us why that looks and similar to what we're seeing today.
What's fascinating about the situation is that we have been through this before, right? This is not the first time that oil and gas companies have not reinvested in oil and gas. You go back to the 1970s, there were some pretty big acquisitions there that are kind of laughable now, right? So Mobil bought Montgomery Ward, which was a department store back in the 70s. ExxonMobil bought Reliance Electric, which was a motor industry that also had office space and a lot of different things. And so oil and gas companies throughout the years have always tried to diversify away from oil and gas at usually the wrong times. Back in 2000s, it was the petrochemical buildouts that led for a lot of underinvestment for 2008 and 2009. And right now, we're in the underinvestment because everyone's trying to show capital discipline and return that cash. But this is a fallacy of composition. One company can do it, that's great. And what's happening though is everyone is doing it. And then that's what creates the scarcity problem we'll have.
All right, so shale. Let's talk about why you guys have believed that shale has peaked.
We have seen huge productivity gains from shale over the past year that have really surprised the market. But what's interesting when you look at the productivity gains and the productivity we have right now versus other time periods like the 1970s, we're actually hitting pretty high levels to the point where you would say it's unrealistic for it to keep going. So if we're not seeing the reinvestment, which by the way, a lot of operators are talking about, and we're not going to get the same level of productivity, while we probably will see some productivity improvements, the double-digit improvements that we've seen over the past year, that's really, really unlikely to continue. But even if we got that, the lack of investment, we're not talking about any growth at all in U.S. shale over the next 12 months.
All right, so now we're talking about decline rates, right? Decline rates. Why have or how have they risen?
So this is what's I think the industry and the market is really missing, right? Because US shale has grown to be such a large part of world supply. Uh, the mix of decline rates, and I'll explain what that is actually increased to a level where we have to replace 4 to 5 million barrels every year. Remember, oil is a depleting asset. We have to replace just to maintain. So pre-shale, world decline rates were only about 3-4%. Post-shale, right now, decline rates are closer to 5%. And why is that? Well, U.S. shale, the wells decline, the production from those wells declined 60% in the first few years. And so you have to spend more every year in order to maintain that. But if you don't, or you don't get the productivity improvement, you will start declining.
All right, and then thinking about some of what we're seeing with some larger operators, right? Some that come to mind: Diamondback Energy, EOG Resources, Occidental Petroleum, right? What do we hear from those folks?
Yeah, so right now, all three of them in the past 6 months have all talked about U.S. shale peaking this year, and the Permian, which it has been the growth engine for the U.S., actually peaking sooner. A lot of people thought that growth could extend through the end of the decade, but it's more likely that we're going to see peak Permian production next year. And I think an interesting announcement that just came out was with Chevron, right? Chevron just announced that they're going to cut their capex to the Permian and keep production flat, right? So they would much rather cash flow the asset rather than reinvest for growth. And that's a key development because most likely they're running out of acreage. And so they just want to keep that production flat for as long as possible. And as they do that, they actually improve their returns over time, which it makes logical sense. But that's the point. The point is we're not growing the Permian anymore, and that's a key difference.
All right. One other big player, Aramco, right? What are those guys signaling? What are they saying about global supply?
Yeah, this is really interesting because they, the CEOs come out a few times and talked about this, but they believe that underinvestment, not peak demand, is what's going to drive the narrative. Very similar to what we're seeing in the capital allocation framework. Uh, they're seeing almost 200 billion of underinvestment in oil around the world. And that makes sense, right? Because the price of oil is low. There's no price response for a lot of people to really invest. Um, but I think the most interesting thing that they have announced is that even though there's been a lack of investment, they're not going to do any greenfield expansion. They're only going to do brownfield expansion to keep their production at 13 million barrels a day. So even the largest uh, supplier to the market is not expanding capacity. So again, this is a key supply side analysis here. We're not seeing any growth from the key basins that we need.
All right. So, question here then, why are markets acting like this abundance will last forever?
Yeah, and that is just because of the way they've been trained, right? They've been trained that we can go into US shale and we can spend money and get production really fast. But that's not how it works around the world. When you discover something, you usually have to spend years developing the laws, the frameworks with the local government. Then you have to spend years building out the infrastructure, building out the local talent. And that takes time. It takes years and years for that, for new investments to scale. And, that infrastructure luxury that shale has really enjoyed for the past 15 years, the rest of the world does not. And so there's going to be there's going to be more gaps in supply that we've had in the past 15 years.
All right, last question for you today. Talk to us about what this means for investors. Who do you think the winners are? What are the risks? What does this look like for everybody?
Yeah, so this is going back to the framework and how we introduced it at the very beginning. What you really want to find is someone who can reinvest in itself to get more scale, because as they do that, they improve their return on invested capital. So while everyone else is pulling back, if you can find someone with one unique asset that they can keep reinvesting in that drives higher ROIC, that company is going to do fantastic over the next 3 to 5 years. You also want to go with the countries who are supporting their oil and gas investments and not moving away from them, creating good frameworks for reinvestment. And we're seeing that right now in a lot of places, and there is a lot of opportunity. I think if you want to take a lens back, just moving outside of the energy spots, which has a lot of opportunity, this also has really good implications for international markets, because a lot of international markets are commodity driven. And for the past 15 years, capital has moved away from these commodity countries and to the US, because trillions have been invested here in the US. Now that's going to change. Investment is going to start flowing internationally, and that's going to be a big growth driver for a lot of international countries, and then also for companies, because they'll be able to start reinvesting and getting higher returns again.
All right, good. Well, Adam, this was great. Appreciate you having us or coming back and joining us. Love hearing about what the Capital Allocation Framework team is doing with these winners and warnings papers. So we're excited to see what comes out next, and we'll have you back soon.
Thanks, Dan.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.